Here is a summary of SentinelOne's Q3 fiscal year 2025 earnings call, focusing on the key financial metrics, management's outlook, and important statements. Overall performance. SentinelOne demonstrated strong execution and business momentum in Q3 FY25. The company exceeded top-line growth expectations and achieved year-over-year margin improvement, with net new annual recurring revenue, ARR, reaccelerating to positive territory. This was driven by solid execution and a record number of customers with ARR of $100,000 or more, indicating a stronger competitive position and increased customer interest. Key financial metrics. Total ARR grew 29% year-over-year to $860 million. Revenue increased 28% year-over-year to $211 million. International revenue also grew 28% and represented 37% of quarterly revenue. Net new ARR increased by $54 million, up over 20% sequentially, and a significant 4% year-over-year, marking a 14 percentage point improvement from Q2. Gross margin maintained a strong 80%, highlighting the platform's unit economics and disciplined pricing. Operating margin improved by more than 6 percentage points year-over-year to -5%. Excluding one-time legal settlement costs, the operating margin would have been approximately -3%, consistent with guidance. Net income delivered positive net income for the second consecutive quarter. Free cash flow achieved positive free cash flow on a trailing 12-month basis for the first time, and is on track to achieve positive free cash flow for the full fiscal year 2025. Customers with ARR over $100,000 grew 24% year-over-year, with customers over $1 million ARR growing even faster. ARR per customer reached a new record. Management's forecasts and future outlook. Full year FY 2025 revenue guidance raised to approximately $818 million, representing 32% growth, up from the prior guidance of 31%. Q4 FY 2025 revenue guidance expected to be approximately $222 million, reflecting 27% year-over-year growth. Net new ARR expected to see stronger year-over-year growth in the second half of FY 2025 compared to the first half. Full year FY 2025 gross margin expected to be approximately 79%. Q4 FY 2025 gross margin expected to be approximately 79%. Full year FY 2025 operating margin expected to be approximately -4%, reflecting a 15 percentage point improvement year-over-year. Q4 FY 2025 operating margin expected to be about -3%, an improvement of approximately 6 percentage points year-over-year. Long-term. The company is focused on long-term share gains, investing in market presence and share expansion, and aims to achieve a 20% operating margin over time. Significant risk factors. Macroeconomic environment. The company continues to navigate a challenging macroeconomic landscape, with organizations remaining focused on cost and efficiency, which is expected to continue. Competition. While SentinelOne sees improved win rates and pipeline, the competitive cybersecurity market requires continuous innovation and strong execution. Sales cycles. Larger enterprise deals, while contributing to higher ARR, can lead to longer sales cycles. Highlights. Net new ARR reacceleration. The return to positive net new ARR growth is a key indicator of business momentum. Platform strength and breadth. The Singularity platform, encompassing endpoint, cloud, identity, and AI-powered solutions, is a significant differentiator. Purple AI growth. Purple AI is the company's fastest-growing solution, with its attach rate doubling quarter-over-quarter. Enterprise traction. Record numbers of larger customers are being acquired, and competitive displacements are increasing, with notable wins against major competitors. Strategic partnerships. The partnership with Lenovo to bundle Singularity and Purple AI on new enterprise PC shipments is expected to significantly increase reach and scale. FedRAMP High authorization. Attaining FedRAMP High for endpoint security and AICM opens significant opportunities in the federal sector. Financial improvement. Positive net income and the first instance of positive trailing 12-month free cash flow demonstrate strong financial discipline and operational leverage. Lowlights. Negative operating margin. While improving, the operating margin remains negative, reflecting ongoing strategic investments in growth. One-time costs. Q3 results were impacted by one-time legal settlement costs, which slightly widened the reported operating margin deficit. Sales cycles for large deals. Larger customer wins, while positive, can extend sales cycles. Most important statements. CEO, Tomer Weingarten. Our Q3 results demonstrate strong execution and business momentum. We exceeded our top-line growth expectations and continue to deliver year-over-year margin improvement. Importantly, our net new ARR growth reaccelerated back to positive territory. The rapid adoption of our Purple AI suite, now our fastest-growing solution, further highlights the value and innovation we bring to our customers. Enterprises are increasingly selecting SentinelOne for our ability to provide real-time autonomous security that adapts to the modern threat landscape while simplifying operations. We're beginning to see notable strength with new and large customer additions. In Q3, we added a record number of $100,000 plus ARR customers, which grew 24% year-over-year. The shortcomings of incumbent solutions are becoming more apparent than ever before. Siloed solutions, closed platform architectures, and human-dependent security solutions simply cannot keep pace with modern threats. We have the right strategy, people, and technology. I'm encouraged by the growth and momentum we delivered in Q3. While early, the investments we're making in expanding our market presence and mind share are fueling one of the highest growth rates in all of software. CFO, Barbara Larson. We exceeded our third quarter revenue and ARR growth expectations. Revenue increased 28% to $211 million in the quarter, with strong momentum across all geographies. Our Q3 net new ARR increased by 4% year-over-year, reflecting a 14 percentage point improvement from the growth rate in Q2. This reacceleration of new business growth marks a return to positive growth. For the second consecutive quarter, we delivered positive net income. We also achieved positive free cash flow on a trailing 12-month basis for the first time in company history. Our unit economics and financial position remain strong with more than $1 billion in cash, cash equivalents, and investments and no debt. We are positioning the company for long-term share gains across diverse growth opportunities. Our investment approach strikes a thoughtful balance between maximizing long-term growth opportunities and maintaining a strong, responsible, and profitable financial profile. In Q3, we incurred one-time legal settlement costs and legal fees that are included in our non-GAAP financials. Excluding these one-time expenses, our operating margin would have been approximately -3%, consistent with our Q3 guidance.